A circus. That's actually the word our source Wolf Richter used to describe the latest Federal Reserve meeting. And it sounds a little dramatic, right? But once you start to look at the details, you really begin to see why. So let's pull back that curtain and see what was really going on inside the big top.
Okay, so on the surface, the headline news seemed pretty straightforward. The Federal Open Market Committee, the FOMC, they voted to cut their key policy rate by 25 basis points. That's a quarter of a percentage point. This was the third cut this year, all part of an effort to keep the economy humming along. Pretty standard stuff, or so it seemed.
And yeah, the rate cut itself, that wasn't a huge surprise to anyone who follows this stuff, but just under that surface, there was this incredible story of deep, deep disagreement unfolding, and that's what we're going to get into. Because this decision, well, it was anything but unanimous.
So you have to ask, what on earth could cause such a major split at the highest levels of the U.S. Central Bank? Well, to really get what happened, we're going to have to put on our detective hats and look for the evidence. So, let's start digging.
All right, our first and maybe most obvious clue comes right from the vote count itself. I mean, it shows a level of public disagreement we just haven't seen in quite a while.
You can see this three-way split so clearly here. While 9 members voted for the cut, you had 3 who dissented. That is the most public disagreement in a single vote since way back in 2019. But here's the real kicker. They weren't all disagreeing for the same reason, not even close.
And this just perfectly illustrates the internal tug-of-war going on. You had Austin Goolsbee and Jeffrey Schmidt on one side saying, hey, let's hold steady, don't cut rates at all. But then you've got Stephen Murron over on the other side arguing the Fed wasn't going nearly far enough. He wanted a much bigger 50 basis point cut. I mean, they were pulling in completely opposite directions.
Now, you might think all this disagreement is a bad sign, right? Like there's chaos at the Fed. But as Wolf Richter points out in this quote, it's actually incredibly helpful. This public dissent gives us a much more honest peek into the real debates and the uncertainties the Fed is dealing with, instead of just some polished, unified statement that hides everything.
Okay, let's move on to our next clue. This one's a little more in the weeds, a bit more technical, but boy does it reveal an even deeper level of uncertainty about where things are headed. We are talking about the infamous dot plot.
So, what the heck is a dot plot? It's actually pretty simple. It's just a chart where each of the 19 FOMC members anonymously puts a dot showing where they think interest rates will be in the next few years. It's not a formal policy promise or anything, but it is a really powerful look into their collective, or, in this case, not so collective, thinking.
And this is where it just gets wild. Look at these predictions for the end of 2026. The dots are just all over the map. You have 3 members who think the Fed will actually need to hike rates. 4 see no change at all. The middle of the road view is for 1 cut, but then you have a full 8 members who see 2 or more cuts. This isn't really a forecast, it's more like a Jackson Pollock painting of possibilities.
Now for our final clue. This one is subtle, but it might just be the most important one of all. It's a quiet little change buried deep in the official policy statement that signals a massive shift in the Fed's whole strategy, happening right under our noses.
So the clue is all in the wording. The old statement on the left talked about ending quantitative tightening, or QT. That's the fancy term for when the Fed was shrinking the money supply. Poof! That language is just gone. It's been replaced with the new text on the right, which says the Fed will start buying government bonds again. This isn't some minor tweak. It is a full-on reversal.
So what does this actually mean for us? Well, after years of basically pumping the brakes with QT, the Fed is now signaling it's ready to gently press the accelerator again. They're moving away from actively shrinking their balance sheet and going back to their old-school playbook where their holdings just kind of grow naturally as the economy grows. It is a major, major pivot happening behind the scenes.
Okay, so we've looked at all the clues. We have a divided vote, we have a scattered dot plot, and we've got this quiet policy reversal. So what's the verdict? What does all this conflicting information actually add up to?
Well, to understand the verdict, you have to look at the Fed's own numbers. They now see the economy growing much stronger in 2026 than they thought just a few months ago. But, and this is a big but, at the same time, they see inflation staying stubbornly high, above their target. And that's the core conflict right there. A hot economy usually needs higher rates to cool it down, but they're still talking about cuts.
And that brings us to our big conclusion. The circus, it isn't really chaos. It's a symptom. It's a direct reflection of this economic tug-of-war that the Fed is trapped in. On one end of the rope, they're staring at a surprisingly strong economy, And on the other, they've got this stubbornly high inflation. It's no wonder they can't agree on which way to pull.
So, the real takeaway here isn't about whether rates are going up or down. The real message is uncertainty. The very people in charge of steering the world's largest economy are openly, publicly divided on which direction to go. And that leaves all of us with the most important question of all. If they don't have a clear map, how are the rest of us supposed to prepare for the road ahead?